Hey, all you money makers, I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. Last week, we talked about how to make big money with puts and calls. And if you missed that video, you can go back and watch it on this channel. But in that video, remember, I mentioned that buying calls and puts in order to make really big profits comes with big risk. Today, I'm going to show you a conservative strategy for generating income. And whether your goals are an extra few $100s or a few $1,000s a month, these conservative strategies can help you get there. And you can do it without taking on all that extra risk. So we're going to do it by selling options that we don't own.
What you talking about, Willis?
That's right. One of the cool things about the market is that we can sell things we don't yet own. So you know the market axiom, buy low, sell high? Well, we're going to sell high first and then buy low, hopefully at a lower price later. And I'll show you exactly how it works. Here's how it works using two conservative strategies, selling covered calls and selling naked puts. Let's talk covered calls first. When you sell a covered call, it's kind of like being a bookie. If you own a stock, you can sell a call against that stock. Now remember from last week's video, the buyer of the call has the right but not the obligation to call that stock away from the seller or buy it from them. As the seller of the call, you have that obligation to sell the stock if the buyer demands it. Now for that right, the buyer will pay you. Let's say you buy 100 shares of Walmart, currently trading at $137. You could sell one call with an expiration the third Friday of December at a strike price of $150. So that December $150 call is trading for $4. Now that means the buyer of the call is going to pay you $4 per share or $400 because remember, options contracts are in 100 share increments. The buyer is betting that Walmart is going to be higher than $150. As the seller of the call, you're the bookie. As the bookie, you're taking that bet. And I've never met a broke bookie. Now for Walmart to pay off for the buyer, that call has to appreciate by 9%. Now, if they want a more certain bet, let's say that Walmart will only be at $140 instead of $150, they're going to have to pay more for that right. Just like a bookie is going to charge you more for betting on the Chiefs than they are for betting on the Jets, because the Jets are terrible and the Chiefs are very good. So the Chiefs bet is more certain. They will charge you more for that bet. Your real risk here is opportunity risk. If Walmart shoots higher to $200, well, you have to sell the stock at $150, and so you miss that upside. But remember, you're getting paid for that opportunity risk. And also to remember, you could always buy back the call at a higher price if Walmart shoots higher if you really want to hang on to the stock. Now, we don't know where Walmart's going to be in December, but you're willing to accept $400 to take on that risk that it will be higher. If it's not above $150 at expiration, the call expires worthless and you keep the entire $400. Now, as the call seller, you have time on your side. As options get closer to expiration, their prices start to decay. So in November, if the stock hasn't moved, that $4 call may only be worth $2. And at that point, you could even buy it back for $2. So you'd have a profit of $200 and then sell another call a little bit further out down the road that would be more expensive and you could make more money that way. The other risk is that the stock falls. And you own Walmart at $137, but remember, you bought Walmart anyway. You own the stock anyway, so the risk is the same as just buying the stock, except now you're getting an extra $400 to cushion that loss if the stock does go down. Oh, and get this, if the stock did get called away at $150, so you have to sell your shares at $150, you still made a $13 profit, plus you kept the $4 that the call buyer paid you. So that's a $17 profit. You've made 12% on your money in just 3 months. One last thing about covered calls, you should only sell covered calls on stocks you're okay with selling, because at some point in your career of selling covered calls, stocks will get called away from you. So only sell those calls on stocks you're okay with selling. If you want to own the stocks for years, then selling a covered call is not the right strategy. All right, let's move on to naked puts. No, this isn't trading options in your birthday suit, although if that's what floats your boat, no judgment here. Remember in the last video, I mentioned that puts are like insurance contracts and people buy puts are often hedging their positions, making sure that they don't lose money if the stock craters. Well, when you sell a put, you're the insurance company. And what do we know about insurance companies? They make a lot of money. There are skyscrapers in every major city with the names of insurance companies on top of them. So these guys make bank. Here's how selling a put works. When you sell a put, you are giving someone the right to sell you their stock at a certain price by a certain date. Remember, when you sold a covered call, you're selling the right for somebody to buy your stock. When you're selling a put, you're selling the right for somebody to sell you their stock. So Walmart's trading at $137. You could sell the December $125 puts for $4. Now, you don't own the stock. That's why it's called naked puts. Now, this means that the buyer of the puts can sell you 100 shares of Walmart for $125 at any time between now and the third Friday in December. If the buyer chooses to sell you the shares, you have the obligation to buy them at $125 or $12,500, again, because that's for 100 shares. And remember, you also are keeping the $400. In order to take on that risk, you are getting paid the $400, just like an insurance company gets paid to take on risk of replacing your house in the event of a disaster. If Walmart's trading above $125 at expiration, you keep the $400, just like the insurance company keeps your premium if your house doesn't burn down. But because you'd be obligated to pay $125 for Walmart, I only recommend that you sell naked puts on stocks you'd be happy to buy at that strike price. So perhaps you think $137 is too much to pay for Walmart today, but you believe $125 is a fair value. So if you're forced to buy it at $125, you'd be okay with that. Plus, don't forget, you receive that additional $4 per share, so it takes your entry price down to $121. Now, the risk is that the stock plummets below $125 and you're sitting on a paper loss. But again, this is a stock that you were okay with buying at $125 at that time. Of course, like with covered calls, you always have the ability to buy a put back before the stock is put to you. But you can see why I say you should really sell puts on stocks that you are happy to own at that strike price. Now, selling covered calls and naked puts are great conservative strategies for generating income every month. So I hope you'll look into it. For more income and wealth building ideas, check out my free e-letter, Wealthy Retirement. Just click on the link below. Thanks for watching. I'm Mark Lichtenfeld. This has been State of the Market.